So I think now everything is fine. I'm your host, Alec, and this is our next workshop hosted by the Ton Nest. It is our program where we support early stage projects who are building on Ton, those who are at the stage of ideas, those of you who are actively building your MVPs, and those of you who are at the stage of pre-traction. And one of the formats of how we interact with the projects and how we support the projects is this kind of workshops, mentorship sessions. We are content, a lot of sessions on our YouTube channel. Upon your request, we are hosting this kind of workshops. Just a second, let me check one thing. Yeah, we are hosting this session to our YouTube channel and to our Twitter. Those of you who are watching us on our YouTube and on our X, please feel free to leave any questions in the live chats wherever you're watching this, and I will be helping our today's expert with facilitating all of these things. And without further ado, I would like to invite our today's speaker, Denis. And yeah, by the way, I already see that we have over 100 viewers across multiple platforms, and for sure there will be a lot of questions. And yeah, hi, Denis.
Hello, Alec. How are you?
Yeah, thank you so much, and welcome to our session. I believe there is no need to say a lot about Denis, since Denis is pretty popular for our community, and a lot of you already know Denis. But still, before we start, I'd like to ask you to say a couple of words about yourself.
Absolutely. So, hello, everyone. Hello, YouTube. Hello, Twitter. I'm Dennis. I'm co-founder of Stormtrade. And Stormtrade is one of the leading DeFi protocols on Ton, with one of the highest TVLs out there in the ecosystem in the DeFi. So we do derivatives. So basically, we allow people to long or short Bitcoin, other RWA assets like Tesla, Nvidia, like Forex, commodities, oil. So yeah, we basically enable trading of any kind of assets, long or short, on blockchain for everyone.
Okay, yeah. First of all, thank you so much for your time. And yeah, according to our today's format, we'll be having something like a presentation, something like a workshop from Denis. And yeah, since we cannot hear those of you who are watching us on X and on YouTube, please feel free to send your questions in chat, and I will be reading them aloud myself closer to the end of our today's session. And this session is planned to be up to 1 hour. So I believe we can spend the last something like 20 minutes, 30 minutes or so, as it's comfortable to you, Denis, for the Q&A part. And without further ado, over to you, Denis, please.
Absolutely. So first of all, there will be no like formal presentation. So it will be just me speaking. But I hope I will actually be somewhat useful. So first of all, the topic of today's meeting is liquidity. And a lot of protocols, they think like, or like, we need to attract a lot of liquidity. Like, first of all, you want to understand like why and what kind of protocol are you building. So first of all, you need to understand that fundamentally there are two different kinds of protocols. One for which the liquidity is basically automatically equal to more revenue, more fees, and so on and so forth, like AMMs, like funds, index protocols, and so on and so forth. So basically, if you are an AMM, then whatever liquidity there is, especially in popular pairs like Ton to USDT, for example, you will get arbitrage opportunities, right? So it's like a classical AMM. So the more liquidity you have, until you match the amount of liquidity on the centralized exchange, where those assets are actually being traded, the more arbitrage volume will come to your exchange, which would automatically mean you earn more fees, which is amazing, right? So you attract liquidity, it will instantly translate to more fees for you. Great. Do this at all costs, and we'll talk about this later. What strategies can you employ? The second type of protocols is where liquidity is more like a liability. So where it enables you to do something, but it's not necessarily translate directly into your revenue. An example being is a lending protocol. You can have 100 million in liquidity, but if no one is borrowing, um, you're in big trouble, right? You need to pay something to liquidity providers, otherwise they will just leave because you just deploy the liquidity to your protocol without earning anything. First of all, it's an opportunity cost for them because they'd better be deploying this elsewhere, right? And it also carries on a certain risk, especially as the protocol is new. There's always a smart contract risk, other misuse or abuse risk, right? So you need to pay them something. That becomes a liability. So you need to understand, like, first of all, what kind of protocol you are, and second, uh, what exactly, uh, how exactly liquidity in the protocol do you utilize. So on to the next thing, like attracting liquidity. Like suppose you have like a protocol, you understand like what do you want and so on and so forth. And yeah, actually, there are different types of liquidity. Again, an AMM example, like you build an AMM for an asset that is traded on the centralized exchange. You have like ton to USDT liquidity, all great. The more liquidity you have, there will be like arbitrage between your DEX and other DEXs, centralized exchanges. Everything is good. Imagine and meme coins like come to your exchange. Okay, they can provide liquidity, but again, if no one is trading them, how do you earn of this? I mean, seeing a large number in DeFi Llama, it certainly feels nice, but that's it. You won't earn on this. So TVL and liquidity is not the only metric that you should pay attention to. In fact, I'm pretty much against using this as a metric like at all, because the only metric that like, matters for me personally is the amount of fees collected. So you collect fees, you're golden. You can have large volumes if you don't collect fees on this. Nah, large TVL if you don't collect fees on this. Nah. So fees collected is the North Star metric. Everything else is basically just something that you might be required to have to increase those revenues. Okay, on to the liquidity itself part. So again, there are basically two types of liquidity provided that require a different approach. First of all are like the crypto users, like the retail guys. Like you create a new protocol, you run some kind of like a points program, and you try to shill it in Twitter and Telegram. You hire some KOLs to spread the word, and you hope people will come and deploy some liquidity to your protocol. That's like the retail stuff. Okay. The second, or I would say, much more compelling option is to go to institutionals. And whenever I talk about institutionals, I don't necessarily mean like huge banks, JP Morgan, and so on and so forth. It's just people or companies who do this professionally, who are like running a DeFi fund. It can be a small fund. It can be like 1 or 2 million fund. It can be very small family office, like a DeFi fund, maybe just a whale who is somewhat strategic about managing his crypto and so on and so forth. And usually, when you're talking with guys like that, you would not attract them to like points program, like widespread and so on and so on. You would talk one-on-one. And you maybe offer them like some additional benefits or not. But the main idea, you would talk one-on-one. And that can be a much more compelling option because, first of all, retail users, they usually follow someone else's lead. So if you already have like million, 5 millions in your protocol, you get some traction, it's much easier to pile in more. If no one is here, then mm, everyone is too afraid to be the first one. And even if someone actually becomes the first one to put their money in your protocol, okay, so how much will they put? Like 1,000, 10,000? That's basically nothing. So you still spend this same amount of effort at like persuading like 10 random guys to come in and put some money into your protocol, and you collected like what, 70,000. That's nothing. That does absolutely nothing for your credibility, for your trust, and onboarding the next 10 guys will be as difficult. But if you spend your precious time and resources on talking to a few either like companies, small funds, friendly whales, um, and you onboard them, they might enter with like 100,000 like tickets each, and you will have at least like maybe like 500,000, maybe a bit less in your protocol, and that will help you dramatically to increase the attractiveness of your protocol to the retail guys. So that's one thing. I would say always prefer, especially at the start, to talk with institutions instead of just like uh, hoping that like your community will provide you with liquidity. Because the second path is much more, I would say, much more difficult. And also, of course, if you know about huge liquidity providers, like funds for managing like a lot of money, or again, a lot is relative. You get the first tranche, which is probably small, but you know that when your protocol grows, you already know where to get more, like because like usually in DeFi, how it works, like your protocol is small, there is like one party who's like providing liquidity, other party like who's actually generating the fees, like a lending protocol, for example. Right? People come in, put money into the lending protocol, other people borrow. So the more people borrow, the higher the APR becomes. So it becomes more attractive to put in more money and vice versa, right? So if no one is borrowing, APR drops and people withdraw their money. So if you only count on the community, then it won't scale. But if you really onboard like some funds, you may not like think about liquidity anymore because people know you, they know that you provide like it's safe, and if it scales, they will always be here to put in some more because, well, it's money, it's yield, and funds are here to collect yield, right? So that's what they do. So that's one thing. Uh, Now about like I would say probably the first idea for everyone who's like trying to bootstrap their protocol is we'll do points. And I would say points are like kind of good and bad idea at the same time. So good thing is, like with points, you're basically telling people that we will reward our early users, which is great, right? And if points are assigned for doing something that is actually productive, like borrowing, trading, basically on the paying fee side, then it can actually help you grow. And again, if there is fees, then there's probably yield to liquidity providers, and it's much easier to acquire liquidity this way. But there's always a downside. So points might create an unrealistic expectations in the community about like the upcoming airdrop or something. People may like want or hope that they would get more than they spent, which they very well could, or they could not, right? No one is like sure about the upcoming in the future, like market conditions. And it attracts more or less a mercenary capital. So points rarely create like really engaged and loyal audience. People come in here, they will come in like with multi accounts. They will try to cheat the system and so on and so forth. So really, if you're doing points, uh, you should be able to filter out unfair participants. And again, this filtering out, if done, I would say that too harshly or improperly, can again create a very good mood in the community, as evident by a lot of the airdrops in the past, right? Like I think like almost half of all the airdrops are actually like met with some criticism for the community, maybe even more. So points are like double-edged sword. It's great. But now I would probably think of them as like points might be introduced at a little bit later stage in the project lifecycle when you've secured the initial community and you've gained initial traction, you have some backers, you have everything up and running, and then on your path to the TG to really bootstrap those metrics, like attract a lot of people, you can introduce points and like people will like come in, farm something, and like at half a year most, they will get there. So like if I am to create a new product right now, I will do something like this, probably. Not start from like the points up front is my like only way to achieve. And of course, like I mean, it's an elephant in the room. First of all, you need to build something useful, right? Because if you are building something without clear like value proposition, without clear like differentiation from other protocol, other things, and you just try to subsidize like the lack of your uniqueness and usefulness, I would say, with points, um, this success would be questionable, right? Okay, so if not points, what can we do? First of all, again, reiterate this. You do a good product and you do a real yield. So there will be some native revenue source based on your protocol, performance. So what can you do? Like if you are doing swaps, do something different. Do not copy Uniswap version 3. Do not copy Uniswap version 2. Um, like research the ecosystem, research what people want, research what other people have done to get more traction. Like research Solana ecosystem, because I think it's a very good example. Like Meteora is a very nice example of niche DEX that actually got a lot of traction because they offered something different from Uniswap version 3 and Uniswap version 2, basically. Some customization with their pool, so people came in, they grew a lot. So that's one thing. Like if you're building lending, again, try doing something a bit different. Maybe it's permissionless. Uh, maybe it's like fixed rate, fixed yield, and so on and so forth. So build a product that's actually useful. And also pay a great deal of attention on who your audience are. So if you're building on tone for Telegram, you should probably aim like at a certain audience that is probably not very crypto native like right now. Maybe you would need to imagine something like completely different, completely unheard of, that would like leverage some Telegram unique things like maybe gifts, maybe something like this. I'm not a very um, knowledge, knowledgeable guy about like NFTs and like collectibles, but obviously they are a thing right now in terms of maybe you can leverage something like this. So basically, you would need to create something useful. So real yield should be there, and you test it on a like small audience. You check if there is a product market fit, if people can actually earn or they found your product useful, so they're paying like some kind of fee, and then you can scale it. No one is just using the product organically. No incentive will have. This second thing that you can do is you can do something that is called the protocol liquidity. So the protocol liquidity is basically when you attract liquidity by like usually it's done when you are selling bonds on your native protocol token, and that's by the way that's one of the reasons why you might completely skip like the points phase and something like go straight for the token, especially if the emission is flexible. Then you can send bonds on your token, get in exchange like real assets, real LP tokens that you can put on your treasury and generate yield. So protocol-owned liquidity is a really good way. Uh, I mean, depending on, I would say, the set of parameters, it can be very much like, I'd say, almost Ponzi-like to something that is very conservative. So again, it's all up to the founders. It's all up to the developers. But it can be one great way of building up like the protocol liquidity, the protocol treasury. And I highly advise everyone who is like into DeFi stuff and is interested on like liquidity bootstrapping to check Olympus and OHM token. Uh, like interesting project with very interesting history and very unique model. So something like this can really help you bootstrap because it basically like, it promises like a very quick return on the bonded token. So it's kind of like really good. So what else? Again, if you already have a token like issue, or again, a great inspiration can be a Curve V33 tokenomics. Again, kind of like a classic right now. So that basically involves staking and locking the token and then voting for a certain like pool or vault and so on and so forth to participate in the token emission. And the emission would basically be proportionate to the fees that those pools are earning, generating. So that actually incentivizes people to vote for the pools with the largest fees collected, which is ultimately very good for the protocol, right? Because our goal here is to earn fees, not just attract some numbers. And those emissions, of course, attract more and more liquidity into those pools, creating a positive feedback loop. And that's the goal of the VE33 tokenomics. Again, it's something that you can only employ if you already have a token that is relatively liquid and people are interested in getting it, even if it's just like for the selling purposes. But still, it is a very interesting model. Again, I highly suggest everyone to research the VE33 tokenomics pioneered by Curve. Obviously, and many other protocols are using it right now, like Curve Convex, like Velodrome, Aerodrome. They all doing the same stuff. So you can uh, research them. And yeah. Next is and like advice that I gave to, I think, some protocol that were building something like um, they were building a solution for the automatic compounding of the rewards in the pools, like uh, Tron to USDT, like Storm to USDT. So the pools with rewards like StoneFi and DDoS, they built a solution that allows you to compound the rewards. So that means that uh, you put in their protocol LP tokens from the DDoS or StoneFi, they restake it for you, and rewards that are here, like additional rewards, because native rewards, key rewards are compounded automatically, but all of the like product rewards, like additional tokens, they'll be exchanged to the underlying assets and put back to the pool, effectively increasing you like yield over year uh, by like 20, 25% of something. And I think this protocol is actually a good example of like the great idea. Like, the idea is great. Like, why should you not use this? If you're providing liquidity to any of those subsidized pool, uh, you're strict better off using their solution, right? Because you get so much more. And also, I think they run like some kind of point program for it. But there were two things, and they were, of course, that they were struggling with TVL, like, oh, no one is using us. What should we do? A really funny story, actually. When I researched what they were doing product-wise, the front end, there were two things uh, that were, I would say, product-wise very bad. First of all, they tried to simplify the like front end as much as possible. So imagine you have this like ton to USDT pair, and this ton to USDT pair is having some additional ton emission. So there is like additional APR, like boosted APR for the ton to USDT. Okay, so their value proposition, again, you restake it through them. This additional ton is compounded like every day. You buy additional ton to USDT, you put it back to the pool, you earn more rewards and more fees. Amazing. So what they do to simplify this, instead of uh like instead of like really displaying this like, or like this is like the reward that you will be getting from the pool is like 20% APY, but with us you would be getting like 35% APY. No. For the simplification reason, what they did, they actually computed the price of like 1 ton to USDT LP token, which means nothing, of course, because it's like 0.05 or something like this. So it has no relation to the price of the ton itself, like whatsoever. And more so, they displayed it as a chart. So they really created this chart of like LP token price to help everyone understand what is happening. Spoiler, it's not helping like at all because you don't even know like price of what you see. But at this moment, I think Tone was like falling from like $7 to $5. So the chart went down. So while they actually provided you with more yield in this pair, the chart that they were displaying to the users like upfront went down 30 degrees last month. So no one really understood what it is about, and why should I put my money somewhere when like the price of something that I don't understand is continuously going down. So why should I do this? So while they actually earned more APY than like your liquidity position on StoneFi natively would be, their display was like really, 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 really bad. So no one was actually using this. And that is actually the problem because they haven't understood that like audience. They try to do this out of simplification reason. They were telling me like, or so we simplified anything. Now you don't like need to care about like liquidity pools and something. But the actual audience are like these DeFi people who are already providing liquidity to the Stone 5, and they want to earn more. They know exactly what they're doing. And they were targeting completely different audience. They were targeting initially this audience that only want to put their Tron or USDT in some kind of pool. But for those people, their product was bad because if I am with my USDT and they had this button, so I can like provide liquidity, like enter the protocol with USDT. So I provide USDT, they buy Tron to USDT. They exchange part of it to Tron, so they provide liquidity Tron USDT and they like reinvest through. But from my perspective of a guy who wants to earn more on his USDT, this product is very bad, right? Since Tron price is falling, if you have like part of your position in Tron, your USDT returns will be negative, which was reflected on the chart. Like, a share, I would say, chart was like going down. So instead, what I proposed to him first, like get rid of the chart. Second is highlight what exactly you are doing so that now like APY in this pool is like 25%. With us, it's 35% due to compounding. And make a one-click button that would allow people to transfer like automatically their liquidity from like StoneFi to their protocol. So they would be able to just put those LP tokens to the good use in one button. And it really helped. So I think they actually like after, I mean, it took a long time for them to actually implement this. But the initial like product from the finance standpoint was amazing, I think. But I think by the time they actually implemented those changes, there were no more incentives on Tron USDT pool. So that's, yeah, not very far. But I think it's a very good example of how a really good and useful at the time product might suffer from a really bad UX. So no one is willing to commit their money to it. And it also highlights the importance of researching why you should really research your target audience and what they're doing. Yeah, and another thing, yeah, again, another example also about the negative returns, like from the personal experience, Storm Trade. Like initially we were operating with Storm Trade. Like how Storm Trade works like, in Freeworks. It's basically traders versus pool, right? So traders, they trade, they pay fees, fees go to the pool. If traders like lose their money, all of their negative P&L goes into the pool. And if traders win, their positive P&L is collected from the pool. And of course, if traders' positions are balanced, long and short is equal, then pool is just basically earning fees, right? Because whatever one side won, the other lost. It's very simple. Last bull market, like small bull market cycle, like BTC, like bull market, in the autumn 2024, there were less, there were like 2 weeks of a very active BTC growth, like 60 to like 100,000 USD for Bitcoin. So the market was really green and traders like started earning a lot. So everything is good. And of course, the price of the LP tokens started to decline because pool was actually paying out trading P&L, which is perfectly fine. We earned our liquidity providers what I think like 25% APY like last year. I mean, it's not APY, it's LY, right? Because it's realized. Now we were like 1, 2, or 3% down, like in a month. I got like, first of all, our TVL halved. Our TVL halved. It went from like 20 million to 10 million. Because we lost like our LPs, like what, 1%, 2%. Second, and again, it wasn't even a loss for most of them because they provided liquidity earlier. So they have some kind of unrealized return. It started to drop, and everyone was like withdrawing as fast as possible. Not everyone, but at least half the people. And please note, when I am telling you like half the people, it doesn't mean it's like actual like people. There were a lot of funds, and now there are a lot of funds who provide liquidity to Storm trade. So those are like institutional people. They know very well what they're doing, how Storm operates, and they were still either withdrawing or they were just attacking my DMs with like, oh, what's happening? Like, is everything all right? Like, should we withdraw and so on and so forth. So when you have this like very clear, uh, like a very clear UI for showing what exactly is happening. I mean, I am all for clearness, right? This is why we have this like chart and so on and so forth. Like no one natively on the DEX will show you how much you lost on impermanent loss, right? You will only be able to compute this using third-party tools. DEXs will only tell you about the APY, like right now, Tone to USDT, APY, like whatever, 10% plus 5% boost, please, like take your money and put it there. They won't tell you about the impermanent loss. If you start to be like this, like brutally honest about what's happening inside, please be prepared that people, like by the people psychology, like whenever you are trying to take something like from them, even if it's like part of their unrealized return, they will very uh, they will be very upset about this, like very much. So it's always a good idea to have some sort of like insurance buffer or something like this that would prevent those situations, like smooth APY out, than to actually like provide like even for some time like a negative return, because that can basically halve your TVL in like what, in 2 weeks. And then we introduced the buffer for this to smooth out the APY. So now the APY was not exchanged directly with liquidity providers. It was now exchanged through the buffer. So part of the fees left in the buffer, and then this like part of this part will actually like distribute to LPs. And although APY always dropped a bit, everyone was back there happy. So now they have like this chart that shows that okay, they have this like steady return, and now everyone's happy. But we really seen this like effect of human psychology. So if you are building something with a directional part in this, and if you have a directional part, it basically means that there can be a negative return, right? Then please try to introduce some kind of insurance mechanics to this, because it's just this mechanics is scary for a lot of people, because it really can be like scary. Or you just understand this and go with it, because like MicroStrategy, like strategy now, like the fund who's buying like Bitcoin, of course it's not DeFi, but it's a very directional strategy, right? They're okay with this. Okay, we are buying Bitcoin. Like everyone can have access to Bitcoin right now by buying our shares. Yeah, we're directional and we're proud of this. That's one way. But if you're building something that should over long term be profitable, but it can be going up and down, like along the road, then try to introduce some kind of like smoothing, some kind of buffer, uh, to keep it like upside only your upside mostly, because ULP will really appreciate it. Yeah, I think that's it. I think, yeah, and it's been like 40 minutes of me like talking straight. So thank you everyone who actually managed to listen to all of my rambling. I hope it was helpful or even insightful. And yeah, please, Alec, I think
Yeah,
it's
thank you so
time to
much.
go like
Mhm.
questions and answers.
Yeah, thank you so much, Denis. That was really interesting to listen to because that is something like a hands-on experience and something that is not possible to look for over the internet, let's say. And we have a couple of, not a couple, but a bunch of questions in the live chats across the sources where we stream this Zoom call. But we also have some of the audience on our Zoom call. Those are the projects that are coming from Nest. And I would like to give a priority to those who are here on Zoom. Those of you who want to ask a question with voice, you can just unmute yourself. You can raise your hand and go for it. If not, I will be reading aloud the questions from the chats one by one. So whoever of you here on Zoom wants to ask a question or bring your case, let's have a conversation about your cases, about your DeFi products, and always happy to listen to you. So let's then start with the questions from the chat, from the live chat. I can just quickly copy and paste them here so that it is more comfortable also for Dennis to read those questions as well. And let me just bring them here. So the first question says, how important is it to have a professional market maker or a VC to provide initial liquidity versus trying to build it early from the community? I believe that was answered, yeah, and probably that question was coming earlier during the stream, and let's then skip that one. And yeah, if you're interested in that, please rewatch the first part of our today's session. The second question says, what do you think the future of liquidity provision on Ton will look like in the next year?
Um, that's interesting. So first of all, the liquidity provision is very different, right? So I would say there's no like liquidity provision like on Ton like per se right now, because really there are different protocols. They provide very different tools and risk profiles for the LPs. So it all depends on the state of the ecosystem, like as a whole. So if you are like hardcore Ton holder, right, investor, you are okay with directional exposure. What would you do? You would try to up the amount of this native that you believe so much into in your pocket. So you would try to do something like maybe Storm Ton Vault, maybe it's like Ton Stakers if you are more risk averse, I would say. Maybe it's EVA. So you would try doing something like this. You would probably not be okay with like rebalancing your portfolio uh, through uh, through the DEX, right? Because whenever you provide liquidity to the DEX, it will automatically means that you short volatility, right? You short vol because you will have the minimum amount of a permanent loss if an asset price stays in like some around the price you actually provide liquidity uh, on, right? So you short wall, and if you are short wall, then you might have some kind of different strategy, right? So it all depends on strategy. In general, I think like I really hope that in general more and more DeFi protocols will be being built on Ton, and together with the efforts, hopefully, of the Ton Foundation and Telegram to bring in more users in here, the DeFi landscape in general will see a huge upside.
Mhm. All right. So are there any questions from the audience on Zoom? If so, please take your chance. If not, we will keep on reading the questions from the chat. All right. And the next question says, when approaching VCs, what are the key liquidity related metrics that they really care about at the pre-seed or seed stage? Is it just TVL or are there more
Yeah,
nuanced indicators they look for?
yeah. So TVL matters, but it's too easy to cheat in this way. So I think, first of all, for me, the most important metric is never TVL. It's fees collected, it's revenue. Because revenue is a universal metric of success. Again, profit is relative. If you reinvest everything, profit will be zero. Like you can have like huge TVL, like huge volumes, no fees collected, so revenue zero. So revenue is the core metric. Only TVL itself. TVL is great. Utilization rate is amazing. So if you have TVL that's well utilized, that's amazing. So it's actually being used. And again, utilization depends on the protocol. So like in Storm, we measure utilization is like basically a ratio from the volume to TVL, like how much actual money was exchanged with the vault divided by the total TVL, right? So that's like utilization. How many there are unique liquidity providers out? Like if it's like just you who like put in some money and call this a TVL, or is there anyone else that you manage to onboard? That's important. What's the API on this TVL, right? Again, very important. What's the ROI on this TVL? So very important. So I would say the TVL itself is just like some high level metric that like the volume, it's kind of there to kind of compare the protocols in the same category. So if you compare two lending protocols, you can very roughly like compare them by TVL. But like talking with VCs, you will really need to get down to those like business metrics like ROI, APY, liquidity providers count, utilization rate. Like those are probably the most important ones.
Okay, and there is a second part from the same author of the question, followed by what are the red flags for investors when reaching out?
Well,
That's a
I'm
bit
not a
off topic.
VC, right? I'm not a VC. I think the main red flag for any VC, like right now, I would say, yeah, I think I have at least one insight on this. Because I was talking with a lot of VCs, like in Dubai, I'm talking during 2020, 49, like this year. And I think the main red flag now for VC is lack of revenue, like lack of real revenue. Like almost everyone now talks about how the projects that are just artificially dilute their own valuation. It's kind of becoming not interesting. And I think the product like Hyperliquid like shows it really well. If you have a product that's being used that's generating revenue, everyone will be feeling great about this. Like the token will feel great, the community will feel great, like VCs will obviously feel great. So lack of real revenue, lack of real useful product is probably the biggest red flag right now.
Mm-hmm. All right. And what else do we have? What is your thoughts on concentrated liquidity like in Uniswap version 3?
Concentrated liquidity is great. Yeah, I mean, what are my thoughts? It's a great product. It have its audience, it have its limitation, right? So do you want concentrated liquidity for Bitcoin, Ethereum, and Ton and other major tokens that are listed on Cypher's, right? Great, amazing. Uh, really, it will generate a lot of fees for the LPs due to arbitrage and so on and so forth. Great. Does it make sense to have a concentrated liquidity on a meme coin? much less so, right? So it's a niche product that is great. It's not a holy grail, like something. Uh, it have it relies on better like alpha than of course like naive liquidity provision like Uniswap V2. Me personally, I very much like the model of like dynamic AMMs with oracles, like Dodo and some other protocols for doing this. Uh, but there are limitations about this as well, because if you rely on Oracle, you have all the alpha, so you won't get any arbitrage volume, or I would say the arbitrage volume would be much less. Will your liquidity providers experience much less impermanent loss? Yes. Will you earn a lot with this? Not sure. Not sure. But again, there is always a but in there, right? Always a but in there. But right now, it's a very interesting thing. Like on Solana, who do you think among the AMMs generate the most volume? I mean, serve the most volume on Solana? Who do you think? And the answer is not someone you can take a look on through DeFi Llama. Like right now, the top volumes on Solana are in dark pools. And dark pools are exactly like this. It's basically like proprietary pools where all the liquidity is probably sourced like from a single fund, no retail access to it, only only aggregators can access those liquidity, and of course they run a proprietary algorithms that automatically adjust like the pricing of those pools, probably based on oracles, like something like this. So most volumes on Solana are there right now, so it's a very interesting thing as well. So yeah, Uniswap version 3, great. Uniswap version 4, great. Uniswap version 2, and like with some additions, like what Meteor did. Amazing product for memes and so on and so forth. But you need to understand like the audience, the go-to-market, how the like, swap will be routed to you. So it all depends. Those are all great models.
Okay. The next question says, thanks, Denis. How much of our own money should we be putting into our own pool start? Does it look bad if we are the biggest liquidity provider?
Um, don't care about how it looks. Do the things that matter from your own product and treasury management side. It doesn't matter how it looks because, I mean, looks, I mean, come on. Imagine you are the biggest liquidity providers in your pool. It will look like, or you take all the fees for yourself. Like in our case, or you will take all the liquidation for yourself. Like you are the bad guys, right? Imagine you put zero like of your own funds in your protocol, or you don't believe in your own product, right? It will look like either good or bad, like either way. It doesn't matter how it looks. You should only look on it through the product and like treasury management side. Like you allocate your own treasury to your pool. Does it provide you with a good enough return? If no, allocate it somewhere else because you need to have money to pay salaries to your team, right? Does it make sense right now to bootstrap our own product and have some like return on this? Please do this. But only care about business metric, only care about revenue. We shouldn't care about how it looks.
And there is a question from one of our Zoom participants, actually. Many projects focus heavily on initial liquidity, but fail to keep it healthy after launch. In your experience, what are the most effective mechanisms on Ton for sustaining and recycling liquidity long term, especially without relying on constant VC injections? Are there tokenomic models or incentive structures that have proven to work best for this?
Yeah, I think I talked about the incentive structure a bit before, like really proven ones like VE33 and protocol and liquidity and like points program and some more. But I think the main problem with Tom protocols is the actual lack of like organic yield for liquidity providers, or or like a very high level of risk associated with providing, like on Tom. It's like those constraints, I mean, they're kind of unavoidable, and you're kind of dependent on the ecosystem. Because again, imagine you're building a lending, right? A lending for the Tom native coins, not coin dogs, like whatever. You will be constrained by, like, in your risk model, by the liquidity for those tokens, right? You can, I mean, can you collect like like a million, I would say, like million in USDT, right? Million in USDT worth of like not coin in your pool as a collateral? Yes. Can you do 10 millions? No. Way too risky. You can't liquidate this as a collateral, right? In case of like something bad happens with the market. So there will be like your hard limit. You will need to do something else or grow with the ecosystem. And that's one of the inherent problems with the ecosystem-based projects. So if you're building natively on Ton, you're kind of limited by the amount of TVL in the ecosystem right now, and by the level of liquidity for native tokens in the ecosystem, unfortunately.
Okay. Yeah, Daniel, if that answers your question, please feel free to elaborate. If not, and yeah, I see one more question from the live chats that I copied and pasted. Is it better to think about cross-chain liquidity in the beginning, or is it better to focus 100% on native Ton assets?
Okay, so again, native Ton assets. Again, but again, there are different pros and cons for everyone. Like native Ton assets, I just talked about them. They're great. They're simple to integrate. You will have a lot of support from the projects, from the ecosystem, whatsoever. People do really have them on hands, but their liquidity is limited. So again, a simple case, a lending. You give out like, I don't know, like USDT as a loan collateralized by Notcoin. How much Notcoin can you realistically hold without overexposing your lenders to the liquidation risk? Not so much, right? If it's Bitcoin instead of Notcoins, or you can grow, hell, you can grow. If it's Notcoin, you're kind of limited. If it's something like, I don't know, any other assets on Ton, it's even worse, right? So 100% Ton native assets, lots of support, relatively easy integration. Everyone is happy about you, but you have these like limits that are in place right now. So you will grow with the ecosystem. You will have a very hard time like outgrowing the ecosystem. You're doing cross-chain. Great. You have access to like, what do you mean by cross-chain? Like, I don't know Bitcoin on Ton, I don't know like Solana on Ton. Why anyone should trade Bitcoin or Solana on Ton? That's the question. So like being multi-chain or like cross-chain, you have access to unlimited amount of liquidity, but also the competition is much more fierce, and you will spend a lot more time like developing stuff, right? It's expensive and difficult to develop for the cross-chain. And again, no cross-chain product will get as much support from the ecosystem as an ecosystem native project. And it's not unique to Ton. Same thing for like BNB, Solana, and stuff. So there are pros and cons, and you should like dig deep into your own project. Like, what are you building? How competitive is it? Like cross-chain? Is it interesting? Like, is it really like a cross-chain project? Uh, and just wait out those pros and cons for yourself.
Okay, and I wasn't able to find any other questions other than thank you words in the chats. And yeah, really, thank you so much, Dennis. It's time to wrap it up. And that was one of the most useful things that we were hosting, DeFi related. We usually don't host a lot of DeFi type of content. And thank you for your time. Thank you for sharing
Thank
your
you very much.
experience.
Yeah, thank you all for watching. Bye.
Mhm. Bye bye, everyone.